Late last week, the idea of a 50-year mortgage was floated to the American public. And by floated, I mean gently pushed like a letter through the door. Almost everyone instantly recognized that it was a remarkably bad idea. A 50-year mortgage doesn't just increase the total interest paid, it doubles it. It makes an already rigid housing market even more fossilized. It introduces structural risks to the financial system. And yes, it ultimately makes homes more expensive. Fun fact: the average first-time home buyer in America is now 40 years old. So adding a 50-year mortgage means a statistically significant portion of buyers will still be making payments after they're dead, which, depending on how things go, might be the most relatable part of this entire story. America is not the only one. Other countries have tried ultra-long mortgages before, and the results ranged from disappointing to historic economic meltdown. But you probably already know all of this. The deeper problems with a 50-year mortgage go much further, far enough to raise two critical questions. If 50-year mortgages are so dangerous, why did we decide 30 years was ideal in the first place? And more importantly, who actually profits from a 50-year mortgage?
To make home buying more affordable, President Trump floated the idea of a 50-year mortgage in social media posts.
A 50-year fixed-rate mortgage.
With President Trump's controversial new idea to help with housing affordability, a 50-year mortgage.
Let's get the obvious out of the way first. A 50-year mortgage won't make homes more affordable. In fact, they'll likely do the opposite. In a fantasy world, stretching payments across 20 extra years should lower monthly payments. And yes, even with optimistic numbers, the difference is far smaller than most people imagine. Take a competitive 6% interest rate on a $350,000 loan for a $450,000 home. For a 30-year loan, monthly payment will be $2,098, and for a 50-year loan, the monthly payment will come down to $1,842. A financially dumb person would say, wow, a savings of $256. But actually, it is not that much for almost doubling the total loan term and the amount of interest you will pay over the life of the loan. Now, some oversmart finance guy will argue, well, actually, if you invest that $256 in the stock market, your returns could outpace the home loan interest and put you in a better financial position in the long term. And sure, on paper, that's possible. If someone invests $256 every month for 50 years at historical market returns of, let's say, 10%, they could end up with $4.4 million, almost 6 times more than the additional interest they'd owe. However, that is all fantasy to assume this kind of flawless discipline, perfect market returns, no missed payments, no human behavior whatsoever. This already rules out 99% of people taking a 50-year mortgage. But here's the important part. This is exactly how these products will be marketed. Not as generational debt, but as leveraged time value arbitrage. Realistically, the monthly savings that we are talking about will actually never become savings, and 99% chances are they won't be invested. They'll be absorbed by existing household budgets, or will become lifestyle expenses. And when that happens, we get the same result we've seen every single time cheap credit is introduced and prices will go up. Like longer auto financing made cars more expensive. Student loans made tuition explode 400% beyond inflation. Flexible consumer credit inflated everyday essentials. And ironically, if we actually wanted to make housing more affordable, 15-year mortgages would do far more good than 50-year ones. Now let's address something conveniently ignored in the monthly savings narrative: the property tax, maintenance, insurance, higher interest rates for longer terms, and long-term capital gain tax. If you factor all these costs in, the narrative of the real monthly savings practically evaporates. So if the numbers are this bad, why are policymakers even entertaining this? The answer is unknown, but policymakers have publicly distanced themselves from the picture. But we still might end up with these mortgages anyway for 2 reasons. 1, they're incredibly profitable for the right people. 2, we might be running out of other options. So let's learn how money works, and how you might still end up holding the bag on a mortgage you never took. Behind every bad idea is either desperation or a profit motive. The 50-year proposal emerged from a meeting between the president and Bill Pulte, the director of the Federal Housing Finance Agency. The FHFA was created after the 2008 crisis to keep Fannie Mae and Freddie Mac from, doing 2008 again. These two government-backed entities buy mortgages from banks, but only if banks meet strict lending criteria. Theoretically, you could walk into Wells Fargo right now and ask for a 50-year mortgage. Nothing is stopping them legally, but banks almost never offer them because of 2 reasons. Reason 1, they can't resell them to Fannie or Freddie. which means the banks giving 50-year mortgage loans will have to hold onto that loan on their books for 50 years instead of making a quick profit by selling the loan the next day to Fannie or Freddie. The second reason banks are not giving 50-year mortgages is because the Consumer Finance Protection Bureau does not consider 50-year mortgages as qualified mortgages. Basically, any loan beyond 30 years does not meet the criteria, which means if a bank gives you a 50-year mortgage and you end up in financial hardship, you could theoretically take your bank to court for predatory lending, and they would have far fewer legal protections. Now, they would still have an army of lawyers, but please don't try it just because someone on the internet said it was theoretically possible. But now the funny thing is the government is currently working to dismantle the Consumer Finance Protection Bureau, cutting its funding and weakening those protections. Remove the CFPB and suddenly the last barrier to 50-year mortgages vanishes. So now banks get 20 extra years of interest, bigger loan sizes, higher interest rates, and more valuable mortgage-backed securities. So why would the FHFA push for something that makes the system riskier? Well, we'll never know, but you all are open for speculation in the comment section. On one hand, 50-year mortgages will make homes even more attractive as investment vehicles. On the other hand, they may delay a systemic collapse of a housing market bloated by decades of credit expansion, tax incentives, and financial engineering. Unfortunately, someone has to feel the pain, and it's far easier for that group to be people who aren't yet holding mountains of debt. If homes suddenly became affordable, the entire financial system would wobble. If prices stay sky high, at least the folks already drowning in debt can keep pretending everything's fine. So, welcome to the everything bubble. Now watch this next video to find out whether there is an AI bubble and can it keep itself inflated forever? And of course, like and subscribe to keep learning how tech and wealth works.